It's October 24th, 1929. The floor of the New York Stock Exchange is pure chaos. 129 million shares are traded in a single day. The ticker tape is running 108 minutes late. Fortunes built over a decade are vanishing in minutes. This was Black Thursday. It was the start of a 90% wipeout in the market. It triggered a 10-year Great Depression. And today in 2025, the exact same patterns are flashing red. To understand why our system is so fragile, we have to go back. The 1920s weren't just a party. They were sold as a new era. That's what the press and the politicians called it. It was the first true age of mass consumption. For the first time, you could buy a General Electric refrigerator on an installment plan. You could buy a Model T Ford for $290. You could listen to the world on an RCA radiola. This new technology, they said, had defeated the business cycle. The U.S. economy grew 42% from 1922 to 1929. Industrial production shot up 50%. The Dow Jones Industrial Average exploded by 300% in just 5 years. It seemed impossible to lose. People believed it. Professor Irving Fisher, one of the most respected economists at Yale, made a famous claim. On October 16, 1929, just days before the crash, he declared stock prices have reached what looks like a permanently high plateau. He wasn't just optimistic. He was certain he was also 100% wrong. Now look in the mirror. Does that psychology sound familiar? We just lived through our own new era. From 2009 to 2021, we didn't just have low interest rates. We had zero interest rate policy for 12 years. The cost of money was zero. We were told this was the new normal. Instead of radios, we bought Teslas instead of consumer credit. We had fintech apps like Klarna and Affirm Buy Now Pay Later. And we didn't just speculate on stocks. We speculated on everything. The cryptocurrency market cap went from $18 billion in 2017 to $29 trillion in 2021. We minted 11 million NFTs in a single week. We bought meme stocks with zero earnings, sending their value up 1,000% or more. The NASDAQ 100 index climbed 530% in that decade. We were told this time is different. We were told AI creates permanent productivity gains. We were told the Fed would always pivot to save the market. We believed, just as they did, that the old rules of value no longer applied. But here's where it gets interesting. A new era always needs a new fuel. In the 1920s, that fuel was debt. Specifically buying on margin. The rules were insane. You could walk into a brokerage and put down just 10% of a stock's value. You borrowed the other 90% from your broker. Let's make that real. You buy $1,000 of RCA stock, you pay $100. Your broker lends you $900. If the stock goes to $1,100, you just doubled your money. You made $100 on a $100 investment. A 100% return. You were a genius. But if that stock fell by just 101%, your $100 was gone. You were wiped out, and you still owed the broker $900. This was the margin call. By 1929, total broker loans, that margin debt, hit $85 billion. To put that in perspective, that was more than the entire U.S. federal budget that year. It was more than all the currency circulating in the country. The system wasn't just a time bomb. It was a skyscraper built on a single toothpick. Today, we don't just have margin. We've innovated. We've created leverage so complex, most people don't even see it. First, there's the margin debt we can see. In 2021, it hit a record $936 billion. That's almost double the peak from the 2007 bubble. But the real leverage is hidden. It's in the derivatives market, specifically in zero DTE options, 0 days to expiration. These are billion-dollar bets on where the market will be in hours. In 2023, zero DTE trading accounted for 43% of the entire S&P 500 options volume. It's the 10% margin call compressed from weeks into a single afternoon. It's automated, algorithmic, and light speed. And then there's the corporate leverage. This is the big one. With 12 years of free money, U.S. corporations went on a debt binge. Total non-financial corporate debt has ballooned to over $137 trillion. What did they do with it? Did they build new factories? Invest in R&D? They bought back their own stock. S&P 500 companies spent over $1 trillion on buybacks in 2022 alone. This mechanically inflates their earnings per share. It boosts their stock price. It's the same game as 1929 margin, just run through the corporate balance sheet. It's the same skyscraper, a different toothpick. So where were the adults in the room? In the 1920s, the Federal Reserve saw the bubble. They were worried. They weren't worried about the public losing money. They were worried about all that margin debt. They saw it as speculative borrowing, pulling money away from productive business. So they decided to cool the market. They tried to pop the bubble gently. They started raising the discount rate from 35% in early 1928 to 4% to 5% by July 1928, and finally to 6% in August 1929. They thought they could curb speculation without killing the economy. Instead, they broke it. The high rates made the $85 billion in margin debt impossible to afford. It was the pin that found the balloon. The market stalled and then it collapsed. And then everything changed. Now look at the last 3 years. It is the exact same playbook the Fed watched as inflation, fueled by supply shocks and 12 years of free money, hit 91% in 2022. A 40-year high. So they did the same thing as 1929. They launched the most aggressive rate hiking cycle in modern history. They took the Fed funds rate from 25% all the way up to 525% in just 16 months. They went from free money to the most expensive money in 22 years. They are trying to cool inflation just like they tried to cool speculation. They are promising us a soft landing. But that $137 trillion in corporate debt is still out there. It's a ticking time bomb. Over $2 trillion of it has to be refinanced in the next 18 months. But it can't be refinanced at 1% or 2%. It has to be refinanced at 5%, 6%, or 7%. For hundreds of zombie companies that don't even earn enough to cover interest, it's game over. The pin is hovering over the balloon right now. We are just waiting for the first pop. This brings us to the human cost, because a crash doesn't just hurt investors. It destroys the real economy, and the people who get hurt the most are always the ones at the bottom. In 1929, the wealth gap was staggering. The top 1% of Americans held 40% of the nation's wealth. The top 0.1% held 25%. A single family, the Rockefellers, had more wealth than the bottom 40% of the country combined. The economy looked great on paper, the roaring 20s, but for millions of farmers and factory workers it wasn't roaring. Half of all Americans lived at or below the poverty line. They had zero savings. There was no Social Security, no unemployment insurance, no safety net. So when the crash came and the banks failed, they weren't worried about their stocks. They were worried about eating. Unemployment skyrocketed from 32% to 249% in 4 years. 1 in 4 people was out of work. That's the 1929 parallel that nobody talks about. The system was top-heavy and it snapped. Today the numbers are eerily similar. The top 1% of Americans now hold 305% of the wealth. The bottom 50% hold just 25%. We have the everything bubble. The S&P 500 is at all-time highs. Housing prices are at all-time highs. But for half the country, it's a different story. 40% of Americans say they couldn't cover a $400 emergency expense. 62% of Americans are living paycheck to paycheck. They aren't celebrating the new era of AI. They're trying to buy groceries. And how are they surviving? With debt. Total U.S. credit card debt just crossed $113 trillion, a new record. And the average interest rate on that debt? Not 6%. It's 2,159%. Another all-time record. The system is just as top-heavy as it was in 1929. The foundation is hollow. It's ready to snap. So what is the pin? What's the catalyst that finally breaks the system? In 1929, it wasn't one thing. It was a chain reaction. British interest rates rose, pulling gold from America. A major London investor, Clarence Hatchery, was jailed for fraud, shaking confidence. U.S. steel production numbers for September came in 10% lower than expected. It was just a few small cracks, but it was enough to make the leveraged investors nervous. They started to sell. The selling triggered the margin calls. The margin calls triggered more selling. It was a cascade. So what's the catalyst for 2025? Take your pick. A major zombie corporation finally defaults on its $2 billion bond. A regional bank fails, revealing massive losses in commercial real estate. A flash crash in the 0DTE market cascades into the broader index. Or the most simple catalyst of all. Sticky inflation forces the Fed to keep rates high for another 6 months. The system cannot survive 5% interest rates. It was built for 0%. The catalyst doesn't have to be big. It just has to be the first domino. So what happens next? Crashes don't happen in one day. They send warnings. The 1929 crash didn't start on Black Thursday. The market gave clear warning signs. On March 25, 1929, the market suffered a mini crash. It fell hard, but then recovered. The bankers led by Charles Mitchell of National City Bank stepped in to provide liquidity. They saved the market. This gave the public confidence. The market then melted up for 5 more months. The margin call started, and the selling turned into panic, which brings us back to today, 2025. Look at our market. Does that pattern sound familiar? We had our mini crash in 2022. The market fell over 25%. But then what happened? Nvidia and a handful of other tech stocks saved the market. The market melted up through 2023 and 2024. It hit new all-time highs. But here is the flashing red light. The rally is not real. It's being driven by just 7 to 10 stocks. The Magnificent Seven: Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. In 2023, those 7 stocks provided 62% of the entire S&P 500's return. The other 493 stocks were almost flat. This is the exact same poor market breadth that happened in 1929. The market looks strong, but underneath the pillars are crumbling. And what is the smart money doing? The same thing they did in 1929. They are quietly selling. Corporate insiders are cashing out at the fastest pace in years. Jeff Bezos sold $85 billion of Amazon stock. Mark Zuckerberg sold $12 billion of Meta stock. Jamie Dimon, the CEO of the world's biggest bank, sold $150 million of his own stock for the first time ever. They are telling you with their wallets that the permanently high plateau is a myth. They are selling to you. So here is the $100 trillion question. We have the new era psychology. We have the record high leverage just hidden in new places. We have the Fed raising rates into the bubble. We have the extreme wealth inequality. And we have the insider selling. Every single signal from 1929 is flashing red right now. The 1929 crash led to a 10-year Great Depression and a world war. The 2008 crash led to a Great Recession and a lost decade for many. What will the 2025 Great Reset look like? Will it be a fast, sharp crash followed by an immediate pivot from the Fed? A controlled demolition? Or will it be something worse? A lost decade where the debt bubble finally breaks the entire system? Which parallel do you think is more likely? A 2008-style recession or a 1929-style depression?